Buddy, good morning. How's it going? How's it going? And, you know, that's just crazy. Crazy. So, hey, Ivan, Don, Craig, Gayton, Donald, David, Jerry, Will, Svenborn, channel members. Glad to see you. Gary, Rob, Arturo, Hugh, Ted, Kimberly, my favorite subscriber, is here. B, Dan, Aki, General Rush, good to see you, sir. Missed you last week a little bit. Diane, Nancy, Cliff, Mark, Jason, Sergio, Scott, Pat. Glad to see everybody this morning. So, this thing we call U.S. government debt. You know, if you haven't been to the debt clock, you should look it up. U.S. debt clock. Elon was posting pictures of it. Move my phone out of the way here. Now, the Federal Reserve, well, we've heard of the Fed and, blah, blah, blah. I talk about how the Fed doesn't control rates and stuff. But it's kind of like a big bank that holds a ton of U.S. government bonds. And they're kind of like IOUs from the government, like they borrow money from themselves. And they promise to pay back money with interest over time. Now, the Fed owns a lot of these, like a lot. And it's a big part of how they manage the economy. Now, there's this idea being floated around about a zero coupon bond. Now, a zero, maybe you've heard about this, doubtfully in the mainstream media, but this is like the solution that they've kind of come up with for how to get the debt to GDP ratio back under control. And they're looking at 100-year zero coupon bonds. So that's like taking our current debt and throwing it out 100 years at a zero coupon. Now, a zero coupon bond is like a savings bond that doesn't pay interest at all. Instead, you buy it cheap, and after a long time, like 100 years, it pays back a bigger amount. And if the Fed trades its regular bonds, which pay interest regularly, these 100-year zero coupon bonds could be worth way less. It's kind of like saying, we're not going to pay you for a super long time. And this could make people think that the government's kind of dodging out on its promises, which a lot of people consider that default on the current time frame, especially if you wrap up debt, the current debt, and throw it out there with zero coupon bonds. It's like when somebody can't pay for property, or any other debt. So, why would this cause a flight from the dollar? What's the risk here? Well, if the Fed does this, people that own dollars or even US bonds or treasuries, even like banks, other countries, investors, they might dump what they have, thinking that the US government might come for their security instrument next. This disorderly flight from dollars and US debt might cause a chaotic risk in the market to dump those dollar risk things. Now, the benefits, the upsides here is that we get the debt to GDP ratio back under control, lower debt in the country. Now, I don't know about you, but politicians, by reducing the current debt, that just opens the door for more shenanigans right here. It's like kicking the can down the road 100 years. But it also makes the debt easier for the Fed to currently manage the bonds and debt that they have. And it buys time, like 100 years of time, which may or may not be a good idea to kick the can down the road 100 years. Now, the risks here are that people lose trust in the dollar. Like, dump all those treasuries, dump all the safe haven debt. And we just had a downgrade in US debt. So higher prices for everything would pretty much be the result of that crazy inflation. But as I've talked to some of you in the background here, the only real solution I see is to inflate away the debt. This kicks the debt down the road 100 years for inflation to really kind of wipe it out. Now, another problem here is that borrowing gets tougher. By kicking that debt down the road 100 years, what motivates people to buy more U.S. debt if it might get kicked down the road 100 years? I don't know about you, but the average lifespan of most of us is not 100 years. So that's kind of like, why would you put any money at risk in that if you may never get it back? So it could cause global economic chaos because the dollar is the world reserve currency right now. And all of a sudden, nobody wants to deal in the world reserve currency. So that could cause economic chaos as we shift to some other currency. And the net result could be a loss of world reserve currency status. And, banks and businesses that deal in US dollars and hold US bonds as collateral could have a big problem on their hands as another fallout of this situation. Now, why is it seen as default? Well, when we sold these bonds and when the Fed did this, they promised, we're promising to pay the debt. The Fed writes bonds, the Treasury writes bonds, and we're promising to pay that debt. So if you're wrapping all those up and kicking them out the road 100 years, it's like most of us aren't going to be around, probably, most likely. So even though it's not full-on default, it's just like, I'll gladly pay you tomorrow for a hamburger today, and tomorrow is 100 years from now. That's hard to deal with when you're used to buying like 2-year treasuries or 10-year treasuries, 5-year treasuries, not 100-year. Anyway, the benefit of this move, it frees up the U.S. government debt. Allows us to work on the problem that we've got right now. The bad thing here is that it kicks this can down the road 100 years, and the risks are very high, and we've never done anything like this before. Not only is the U.S. government thinking about doing this, but the Japanese government also thinking about doing this, and they've only been, playing this game for 20 years. Not the zero coupon game, but the high debt to GDP ratio game. And this is looked at as kind of a solution, but it may not be the awesome one that they think. The risks are very high for this to blow out. So hopefully that helps everybody kind of understand one of the ways that they could solve the high debt to GDP ratio. Hopefully that was helpful, beneficial. Diving into more of these deep concepts, you can give me feedback. Let me know in the chat. Let me know in the comments if this sort of thing is helpful, if it's, you like these topics, or you have suggestions for other topics you want me to cover, deep dive into. I do appreciate the input. I've been kind of trying to think about ways I can help you all understand some of the risks that we have going on right now more deeply. So, how do we make money today? All trading involves a substantial risk of loss, and past performance is not necessarily indicative of future results. Just because things have worked in the past doesn't mean they'll keep working. This presentation intended to be informational, educational, fun, entertaining, not a recommendation to be buying or selling any financial instrument, including stocks, options, bonds, forex, futures, cryptos, treasuries, all the things I just talked about. If you desire personal financial advice, hire and consult a financial advisor. That's not what I'm doing. I'm not trying to tell you what to do. I'm not trying to tell you how to make money. Unlike a lot of YouTubers out there that bang the drum, like, just do what I say and you'll make tons of money. Yeah, that's bullshit. Absolute bullshit. So, look at the week here, economic news-wise. We've got nothing today, nothing tomorrow. Interesting that part of the world's on holiday, looks like. On Wednesday, we got CPI. That should be a fun one. Could cause some flush. PPI on Thursday. That's inflation, basically. And then Friday, we get some consumer sentiment and inflation expectations from University of Michigan after the markets open. So CPI, PPI, noticeably absent. Retail sales, kick that one out to next week, I guess. Let's see, where's retail sales? Yeah, coming in on Tuesday next week. Usually PPI and retail sales are together. They've been decoupling, or retail sales has been bouncing around lately. Now we get the FOMC next week. So if you've got VIX that you're wanting to cover the FOMC with, you might want to look at some July. Jump out to July or later even. And let's see if I can find. Let's see. I had up a chart the other day. I think it was. I don't remember where it was. Where I should have put it in my stuff for videos, but I didn't. There it is. Here it is. This right here. June. So you look at the 18th. VIX options standard expiration. So that happens in June, on June 18th right there. So you fly out to July, that's the 16th, be the standard. If you fly out to August, that'd be the 20th, the standard expiration. It's the third Wednesday of the month, basically. Although October, fourth Wednesday of the month. I guess third Wednesday of the month, unless the first Wednesday is the first. It's all sorts of weird, this is just the CBOE's main option expiration calendar right here. It's helpful for, figuring out these weird, you got VIX weekly expirations. They always have it on Wednesday, oddly enough, not on Fridays like the rest of everything. So that messes with a few people that the VIX options expiration is on Wednesday. And if you buy the AM settled one, the bright green is the last day to trade expiring standard AM settled equity index options. That includes, S&P, NASDAQ, Russell. That's what they're talking about there. So if you've ever looked at it, at those contracts are special, and they're European style. They're cash settled, no early exercise. If you're like, wait a minute, all these things are different. Yeah, if you ever play in the normal index for the expirations, there's no early exercise. They're cash settled. You can control your loss, when you get executed, or if you get executed. Basically, it only happens expiration day. So as long as you're out by the last day, there you go. The blue is the last day to trade VIX. So as we can see, for this month, 17th, which is the day before FOMC. So if you're in the standard monthly, you have to be out by the 17th if you're going to book profit. Hold it into expiration, that's your donezo. So the June options will not cover the event on the 18th, is the bottom line here. Bottom line. Hopefully that helped too. All right, moving on. Back to S&P, finally open. A little bit of red. Let's see what the overnight actions looked like. Jump down. So we reopened Sunday night, 6 p.m. If anybody didn't know, rolling on back. Right there's the open, little red. Continued the correction, I guess, off of the high we made right back here on Friday. Came back up, retested that price action right there late in the afternoon on Friday, and we're just hovering. We we did not hit the upside target. I mentioned that on Friday that we might reach up and hit that upside target. We didn't do it. We got close. Close doesn't count if you have an order at 60.2850, and we topped out at 60.25. So this still has potential to spike that area right there around 60.30, 60.2850, 60.30. Still got that potential. You can watch the 15-minute. We start breaking down below it. It goes higher time frame. Next support, 30-minute, right about there, 59.79. Really, the big support is 59.60, I think it is. Let me see. 59.60. This 1 hour right here. We've been bouncing off of it pretty good for a while. So 59.60, we start breaking below that. It starts tipping the odds that we're done on the upside for now. And we're probably going to come on down to the 4 hour, if not the daily, which is kind of hanging out in the same zone. And then the weekly, probably not going to visit that, but we could do a bigger 618 retrace off of this move up here. Lots of risk in the market right now to the downside. Now we could grind it higher. We grind this on up. I've talked about it for, gosh, talked about the risk here quite a bit. Switching back to the cash index, this looks eerily similar on this weekly chart to the 3-day that we did back in 2007, right before the wheels came off. Now a weekly is a bigger time frame, so that means bigger problems, bigger potential correction in the market. We fly back here to 2007. I just want to, I'm beating the drum on this because it scares the crap out of me. See this right here? Dip down, ramp back up, made a new high. It's like kind of what we're doing right now. Grinding up here. No pullbacks on this move up right here. No pullback. Didn't do anything. No pullback whatsoever. Just shot right back up there. You know what happened next? That happened next. 57% pullback in the market. Maybe like, well, there is no way we're doing that right now. That kind of complacency can get you in big trouble. All right. I'm just throwing it out there. I mean, look at this right here. Just for giggles, let me snapshot that right there. Pop it up. We'll go back to the current. Jump up to the weekly, and I'll show you what I mean. Like why this is eerily similar. In fact, let's go over to a clean chart. Right here. Kind of explain this very well, what I was thinking, but just in case. Let me show you what I'm talking about. Let's see, shrink this window. Look at that right there. Let me zoom it up just a bit, make it a little bit bigger. See how I did that?